Hi, everyone. Welcome back to the Future of Finance podcast. I'm your host, Marissa Wood, and today I'm joined with business partner Lisa Green.
Thanks for having me back.
Thanks for joining. This is your third episode now, so
right.
You're getting the hang of this
I
podcasting
am.
thing.
I was just reminded it's my third.
Yeah. And so today, me and Lisa are going to speak about the biggest financial mistake that each generation is making. And when we were thinking about, what topic we wanted to cover today, we realized that, not only are we two generations that are running Union Financial Services, but we work with clients from every generation, all the way from, those that are 20 years old just getting started to those that are planning, their legacy and everything in between.
And we're lucky to do that. And because we are from different generations, it makes our clients feel a little bit more connected to both of us. So we're lucky in that respect.
Yeah. And I mean, while each generation has amazing aspects about it, they all do have some common mistakes that we see people making. And, the strategies and the planning that we do for each person should be customized to where they're at in life. And
Absolutely.
so we're gonna go through that today. And I think our listeners are going to be excited to hear what their generation's biggest mistake is and maybe some strategies that they can implement themselves.
That's our goal here. We just want to help them out along the way and maybe connect with them in such a way where they're thinking, well, I think I do need that in my portfolio.
Sure.
It's very important to work with a financial advisor. This is a tough road to do on your own. There's so many different variables and so many different options that you may or may not know. So hopefully we can give you some information today.
Yeah, absolutely. So we're going to start with your generation, the baby boomers.
The infamous boomers.
Yeah.
Right. There's a lot of us.
Yeah. And so I'll let you take that because I think you understand what the baby boomers are going through a little bit more. And ultimately, you've worked with hundreds of clients that are approaching or in retirement in that baby boomer era. And so what would you say would be the biggest mistake that they're making?
The experts are saying the biggest mistake that the boomers are making is not planning for long-term care, not putting aside those finances for an extended care event, because if that comes up, it can literally drain your entire financial plan. So we do want to talk about that. We did discuss it a little bit in episode 1 on some investments that have extended care features, but we're going to dig into it a little bit today. We're going to skim the surface because there are some, not necessarily mistakes, but there are some strategies that boomers can use in order to have that portfolio where they want it to be and where it should be. They've worked a long time. They've accumulated a good amount of wealth. The difficult part is distribution and having that safety net so that nothing will derail your plan.
Yeah, I mean, I think it's everyone's worst nightmare to get to retirement with a nice lump sum of money and then either themselves or their spouse has an extended care event, chronic illness event that decimates those assets that they've worked their whole life to save. That's terrible, and it's common.
We've seen it happen.
Yeah.
We've seen it happen. But the good thing is there's a solution. So the first strategy that I believe that boomers should address is estate planning. They need to have their ducks in a row. They need to have their will, their trust if necessary. They need to just have that security of checking off those boxes. It's very important to have an estate plan. Things happen and all of a sudden time gets away and people realize, oh, I never did that. Try to do that sooner rather than later. Because there's ways that they can gift their money also, strategic gifting. That's a nice tax break. So let's look into that option.
To their heirs or charity.
Exactly.
Yeah.
They can use those RMDs that they're forced to take for a charitable distribution. Save on taxes on that. It's good. The other thing that is very important is we need to protect a portion of our assets from market volatility. We are in very interesting circumstances right now.
Yes, we are.
And the way we can protect those assets, a portion, is with a fixed indexed annuity. FIAs absolutely deserve a place in baby boomers' portfolio.
Mm-hmm.
There is no if, ands, or buts. You need to protect a portion of those assets that you worked so hard for
Mm-hmm.
from market volatility. You are no longer working, probably. So you do need to have that safety and security.
Mm-hmm.
And the good thing, and I'll circle back to episode 1, the good thing about those fixed indexed annuities is a lot of them have a plan for extended care built inside.
Mm-hmm.
I'm not talking about just a standalone long-term care plan. I'm talking about an investment that has extended care features right inside, and it acts like a safety net.
Mm.
If you ever need it, it's there. If you don't, it's still an invested asset.
Mm-hmm. That's growing.
Oh, it's growing
Mm-hmm.
and it's got protection.
Mm.
When I say that's the best of a lot of worlds,
Mm-hmm.
I truly believe that. And
Mm-hmm.
I think that every baby boomer should have that in their portfolio.
Mm-hmm.
They need it.
Absolutely.
Their children need it for them.
Absolutely.
Because if you don't have that, you're subjecting your family to possibly putting their lives on hold, taking care of you, financially contributing to that type of a situation.
Mm-hmm.
It can be pretty devastating, as you said earlier.
Mm-hmm.
But working with a financial advisor, when we tell our boomer clients that this is available to them, I'm hard pressed to find someone that doesn't want it.
Because how can anyone say with certainty, I will never have a chronic illness or a long-term care event?
Right.
None of us know.
Right. And longevity plays a factor in that as well.
Mm-hmm.
We don't know. And we need to protect ourselves, our assets that we work so hard for, and our family.
Mm-hmm.
And it's an easy fix.
Absolutely.
Yeah. It's a pleasure to be able to share that information. So, the last thing that is very important too for baby boomers is to introduce your financial advisor to their family.
Mm.
Let's meet your children. Let's meet your beneficiaries. Let's meet your sisters or whoever may be the next of kin.
Mm-hmm.
Let's meet them so that they know who we are, how we can be contacted in the event that something happens. You know, boomers like to think that they're all still 50. Then all of a sudden we say, we can collect Medicare? How did that happen? You know, we do have that tendency to just think that we're still young.
Mm.
We're not. You know, we're in the twilight years.
Mm-hmm.
And we can have those twilight years be as wonderful as we envisioned, you know, or they can be a little stressful.
Mm.
But if you work with a financial advisor, even if it is a little late in your life, let's have a conversation. Talk to your advisor. See what's available for you.
Mm-hmm.
Try to make those retirement years as seamless and as fun as you had thought they would be.
Yeah, that's our job.
It's our
It's
job
to help people spend their money without running out.
Mm-hmm.
And yeah, that's very smart about having us meet our clients' beneficiaries and family members, because we can be there during that difficult time to help them with the paperwork and to help them crunch the numbers. I mean, I've seen you do it the last 10 years that we've been working together. I've seen you process countless death benefit claim forms, go to their house, be there
Mm-hmm.
during that difficult time. Even, one of our dearest clients, I know that you've helped her when her parents went into a chronic illness event and needed the funds, and
Right.
you helped them efficiently distribute them.
Right.
And, that probably meant the world to her. But had you not met them,
They may not have
they may
reached
not
out.
have known that that was something you can help them with.
Exactly.
Yeah.
Exactly. So it is, even if it's just a phone call or an email communication, a lot of our clients, we tell them, here is our business card. Please give this to your children
Mhm.
or whoever may be that beneficiary. Please let them know that we are here for them in the event when something may happen.
Mhm.
So it's our pleasure working with clients through their accumulation years. And unfortunately, in the end, we may have to work with their family
Mhm.
members, but that's part of our job.
Yeah.
Mm-hmm.
So the boomers' biggest mistake is overlooking that extended care, long-term care planning inside of
Yes.
that portfolio. And so, to any boomers that are listening to this, if you're not sure if you have that checked off, let's have a conversation.
Mm-hmm. It's definitely a worthwhile conversation.
Mhm.
And I also want to remind boomers that retirement is not an age. They may think that at 65 they can retire. Retirement is a number.
Mm.
You need to know that that number coincides with what your expenses are, what your goals are. Just because your parents retired in their 60s, early 60s, doesn't mean that that's right for you.
Mm.
Once again, have that conversation with an advisor.
That makes sense.
It's math.
Yeah,
It's all about math.
that is true. That is
Mm-hmm.
true.
Mm-hmm.
So then the generation after baby boomers is considered Gen X. Now, that's they're the current sandwich generation, we like to call them. And, for anyone that doesn't know what that means, it means that oftentimes they are taking care of children and aging parents. Whether that be financially or just physically, they're kind of being pulled in two directions, which,
Mm-hmm.
wonderful that they still have their parents and the next generation, but that can be stressful mentally, financially, which kind of brings us to the mistake that we feel as though Gen X is making.
Yeah, the Gen X does have a lot on their plate.
Mhm.
Sandwich generation, no pun intended, but
Yeah.
they do have a lot on their plate.
Yeah.
And they're stressed out and they're working hard and they're trying to take care of their kids. The problem that we see is they prioritize their children's needs before their own. The reason I say that is we see a lot of Gen Xers withdrawing from their 401k to pay for their kids' college,
Mm.
as opposed to letting that child get a loan. Now, when you think
Mm.
about the numbers there, once again, it's math. So if they withdraw from their 401k prior to 59 and a half, they are immediately hit with a 10% penalty.
Mm-hmm.
And then they're going to be hit with a 20% tax.
Mm.
So there is 30% immediately going away from that 401k.
Wow.
And is that a great strategy to use for college? No. Is
No.
that a great strategy to pay for a child's wedding? No,
No.
that 401k is there for their retirement. We
Mm.
see that mistake a lot with the Gen Xers. And I
And
think
their
that
heart's in the right place.
it
I mean, how
is.
wonderful you want to help your kid out,
It
but
is.
you're never going to be able to retire if you do that.
No. No, they're never, and that 401k is not a checking account.
Mm.
That is a retirement savings account. And hopefully they've been working long enough where they have a nice balance in there, but that is for retirement. And so there needs to be other options. That's usually a quick solution. Oh, I'll just withdraw from my 401k.
Mm-hmm.
Not a great idea.
Yeah. So, managing debt properly is so important. Student loans and mortgages are considered really good debt because the interest rates are relatively low compared to credit cards or, getting hit with 30%
Mm-hmm.
charges from withdrawing from retirement accounts. And then, you know, it's okay if your child does have a little bit of a student loan.
It is. Like you said earlier, their heart is in the right place.
Mm-hmm.
But let's be practical. You've raised your child to be independent. If that student comes out of college with a loan, that's fine.
Mm-hmm.
The rest of the generations have had to handle that as well.
Mm-hmm.
So let's prioritize as a Gen X, let's prioritize ourselves while taking care of our
Mhm.
family. We can do that.
Mhm.
It doesn't have to be all or nothing.
Mhm.
And the other thing too is Gen Xers, they may have a high mortgage. Well, look into when the rates go lower, look into refinancing that.
Mhm.
Look into something that's a better solution. Maybe you'll have more cash on hand at that point
To invest.
to invest. Their future is important as well.
Mhm.
As I said, I feel as though boomers did a great job saving. Gen Xers, not so much.
Mhm.
Not as well as they should have saved.
Mhm.
They're still working, so there's still time. So what they need to do is max out that 401k contribution
Mhm.
with the company match.
So if the employer's matching 5%, you should definitely put 5%.
You should definitely put 5%. And there is another problem that I see that they do. They tend to just let the employer pay into that 401k. That's not a great idea. You need to match that, and you need to be able to live without that $1,000 here. You
Mhm.
can do it,
Mhm.
but there needs to be a little discipline. And, once again, financial strategies are emotional. They're about discipline.
Mhm.
They're about sometimes sacrificing a little bit, but you can do it now for your future.
Mhm.
Yeah. So Gen Xers, the best thing that they can do for their kids is to be financially stable themselves,
Mm. That's powerful.
right? You
Mhm.
want to always do things for your kids. Well, take care of your finances now so that your kids don't have to take care of you later.
Yeah.
Very
Be able to
important.
retire yourselves,
Mm-hmm.
have guaranteed income in retirement,
Mm-hmm.
have a plan for long-term care. You can start laying these foundations
Right.
in your early 50s,
Right.
and then your children will not have to worry about you, which is really an amazing gift to give your kids, I think.
It is. Yeah. And it's not too early. Even though we talk about, guaranteed income a little later in life, there's a conversation to be had with these Gen Xers about guaranteed income, extended care options, just to, as you said, lay the groundwork. Let's have a conversation. Let's let you know what's available to you now.
Mhm.
Now, in 10 years, when you're closer to retirement, I'm sure the outlook is going to be a little better.
Mhm.
But as long as you know that there are options, start addressing it.
Mhm. Yeah, and we have great software that, we can sit down with someone and go over what their current expenses and income are, their current asset level, and then project it out 15, 20 years. And, you know, Gen X is right on that cusp of really needing to see that visual and making the changes now before it's too late. And
Exactly.
so we can do that for people.
Perfect time for them to do that.
Mhm.
You're right.
Yeah, absolutely. Okay, so the Gen X mistake is prioritizing children's expenses over saving for retirement themselves.
Exactly.
And I think that's really common, and a lot of our listeners will probably,
See themselves.
relate to that.
Mm-hmm.
But it's not too late to get back on track at
No.
all.
No.
Okay, and then the next generation is my generation, the Millennials, which I'm kind of right on the cusp of millennial and Gen Z, but I still am a millennial.
Mm-hmm.
And the biggest mistake that I see my peers making is waiting too long to start investing, delaying that initial starting of investing. Because, what we see is people feel like they don't have enough to get started.
It's never true. That's
It's not
never
true.
true. It's always a good time to start is today, no matter
Mhm.
what you have. And once you get started, how about that light bulb going off?
Yeah.
Wow, I can do this.
Yeah, the reality is you do not need to be rich to get started,
Right.
but if you ever want to be rich, you have to get started.
That's great.
I mean,
That's great
honestly,
advice.
because there's no amount too small, whether it be, $50 a month, $100 a month. Taking that first step, you're going to start seeing that compounding interest effect. And that is one of our strategies, is to start, number one, and then do it consistently. Set up those additions on a monthly or biweekly basis, whether it be into your 401k or an investment that, we can help you set up separate from your company, adding to your account so that you're taking advantage of dollar cost averaging, which for anyone that doesn't know what dollar cost averaging is, it's when you're buying in on a consistent basis, usually with the same dollar amount, and you're buying different amount of shares every month depending on where the stock market is that month. Let's say in May, the stock market is up and you add $300 to your account. You might only buy 3 shares of whatever fund you're investing in. The next month, June, the market is down. Everything's on sale. Everything's cheaper. That same $300 bought you 5 shares. And so throughout the course of the year, you're going to have a lower average cost per share than someone that just picked one random day throughout the year to
Great
invest.
advice.
Yeah.
The other thing that we see with millennials is that defeatist attitude. They say, Social Security is not going to be there for me. I'll never get to have that nest egg that I want. So why don't I just spend it on vacations with my family? Once again, people want family time. Of course you do. And you're working towards saving for those fun times, those vacations. A lot of people love to go on cruises with their families now. That's okay. You can do that. But don't have the attitude where it's never going to matter, so I'm just not going to do it. We have heard that. And
Yes.
that's disheartening. Because if you don't do it, nobody's going to do it for you. Yes, Social Security will still be there. It may look totally different, but some sort of Social Security that you're all paying into is going to be there. You can take those vacations. You can save for retirement. You just need some guidance.
I understand the hopeless attitude of millennials a little bit. I mean, we've seen
A lot.
a lot of, financial turmoil, global everything. We won't get into that, but we've seen a lot in the start of our working lives. And, inflation has caused the cost of living to be a lot higher than, previous generations when they were just getting started. But we also have so much to our advantage.
You have resources
Exactly.
that other generations didn't have. They didn't know how to use it. Your generation knows how to use everything that's at their fingertips, and you do. And that's great. So let's put that positive spin on it and just, once again, get started, be consistent, and you will get there. So
Absolutely.
our goal is to try to talk to those millennials and let them understand this is fine. I can do this. When that happens, that revelation and that light bulb goes on, wow, we are on our way. It's no longer the defeatist attitude. And like you said, no matter what the amount, let's get it going. Let's have that goal. Let's have conversations. Financial world changes daily, and things are available daily. And we can help you get to that point that maybe your parents are at, and you look at that and say, okay, I can do that. It's going to look different, but it's possible.
Yeah. It should be exciting. And, I think our clients feel the excitement.
They do. They do. I mean, the smiles and also that sense of accomplishment that I've checked this box off and I am on my way. That's very important. And if couples come in, they feed off of each other with that. It's like, we can do this. And then of course we talk about the kids, and once again, big priority. But we can have a nice plan that will give you time with your kids, give you those vacations, maybe set something aside for their education, but still have the number 1 and 2 priority being that those parents or that couple.
Yeah.
So it's a great place to be.
Yeah. I mean, I personally love working with millennials, not only because I relate to them, but also because if we lay the right foundation as millennials with investing, that Gen X biggest problem, baby boomer biggest problem won't ever happen because we're already going to be planning for it. And we're not going to really need to make many changes.
So true.
You know, the other thing that is important as millennials, a good strategy is to take advantage of tax-free accounts, such as the Roth IRA, fixed index universal life insurance. Start contributing to those now because they all grow into a tax-free asset that you can access in the future. And who doesn't want a tax-free asset and tax-free income? I don't know anyone that wouldn't want that.
Because you do not know what tax rates are going to be
Exactly.
when you retire and when you need all of your assets to live on.
Mm-hmm.
Let's think about it. Wow, what's it going to look like in 30, 35 years?
Mm-hmm.
Take care of it now and you won't have to worry about that.
Exactly.
It's all about peace of mind.
Exactly. And I mean, the sooner you start with any tax-free account, it's going to be able to grow to a larger amount.
Mm-hmm.
And that's our goal.
Right.
And then I would say the last strategy that is very important as millennials is to have that emergency fund and to create a budget for your household.
They don't like that.
No, it's not fun. You don't want to see how much your bills are, but you need to. You need to see if you're living within your means or beyond them. Obviously, meet those savings goals as well. Budget saving.
Budget saving, emergency fund.
Yeah. And we have some really good budgeting tips in episode 2. We go through a sample budget that a lot of young families are finding useful. So I would encourage you to go back to episode 2. But that is important because young families, they're in those working years, they have their children.
They're busy.
They're busy, but they need to have a framework
Right.
for their finances.
Right. Because a lot of millennials just will spend and order on Amazon and then everything starts to snowball.
Mm-hmm.
And then they say, well, I can't budget.
Mm-hmm.
I need this or I need that.
We do have a
Sometimes-
template that we can send out to people,
Yeah.
Where you can plug in your own numbers without having to create a whole plan for yourself.
Right. Because wants and needs are different things.
Mm.
You need
So
to
true.
address those wants and the needs. Maybe those needs can be checked off a little bit. Well, do I need that great handbag? Maybe I'll check that off and not get it.
Yeah.
My needs have to come first.
Yeah.
And I think that that's a difficult thing for a lot of people, but I think specifically millennials.
Mm-hmm.
They're not used to separating the two.
That's a good point.
Mm-hmm.
That is a good point.
Mm-hmm.
Okay. So, yeah, absolutely. Delaying investing, not to your favor, millennials. Got to start now.
Got it. Stop.
And then the last generation that we want to discuss is Gen Z, which is, right below me. And they're the first generation that really has never lived without technology.
Right.
And so they have a different outlook on life. They're used to things instantly. And that can be good and bad. I would say, and I think you would agree with me, that the biggest mistake Gen Z is making is overusing credit cards, racking up that
Absolutely.
high interest debt.
Absolutely.
Because it's easy to do. We have Amazon, we have Uber Eats and Grubhub and every other app that it makes it too easy to spend money.
Yes. And Gen Z, they're an interesting group. They want to be their own boss. We were just discussing that Fortune magazine article. There's a lot of Gen Zers that insist on doing startup companies.
Or being an influencer. Yeah.
That's great temporarily, but sometimes you need to get out there in the world, work for somebody else, and then be your own boss down the road. They want to jump right in. They just think that they should. And maybe it'll work for a short period of time. Hopefully, but it's not going to work for everybody.
Yeah, I mean, I admire the entrepreneurial spirit of Gen Z, but yeah, there has to be a little bit of stability in that plan.
Absolutely,
For sure.
yes.
And The worst thing that you can do for yourself, especially if you're starting a company, is rack up a bunch of high interest debt with credit cards. Our advice would be use credit wisely. Do not buy something that you know you cannot pay off by the end of the month. If you can't buy it. Sorry.
They have to be disciplined. And that may come with a little bit of time because they are young. As you said, they had access to all technology from the very beginning, from when they were small. I was just listening to a podcast, and that financial expert said and he specifically was talking about Gen Z, he said if an 18-year-old, so that's a little bit younger maybe, but if an 18-year-old put aside $500 a month by the time they were of retirement age, and it was, somewhat invested in a conservative, not necessarily aggressive, they would have $4 million. So
Wow.
Gen Zs will say, well, I can't put aside $500 a month. Well, how about 250? I bet you can. That's $2 million.
Yeah, wow.
So when you say those numbers, especially because Gen Z are the youngest generation that we're discussing, when you remind them of those numbers, maybe a little discipline will come in. Maybe a little bit of, well, I can reach that goal. It's once again, goals and accomplishments, very important, and it's about your money. So you need to stress the fact that, and young people say, financial advisor. I don't need a financial advisor. Well, maybe you do. Maybe you should have a conversation. Maybe you can't find all the answers on the internet. Maybe that self-directed account can produce better results. You can have input with your financial advisor, but it's what that financial advisor does for a living. They're going to have more knowledge than you, believe it or not, as a Gen Zer.
And, sometimes we do meet clients that are really well versed on, picking
Exactly.
stocks and investing, but what they lack is the accountability factor. How much should be invested? When is the right time to pull it out? Can I afford this purchase? It's important to have someone that you can bounce ideas off of. Even the best golfers in the world have a golf coach.
Very good.
I'm saying that because we just watched the Masters this weekend, but it is true. You have to have that advocate and someone that's going to help you make decisions along the way. And you're never too young to start that. And so building credit wisely, obviously super important. Use credit for things that are going to be investments for your future. Student loans are good debt. You're building an education. Getting a mortgage is a good debt. You're going to have an asset. Overpaying on cars and credit cards, not good debts.
Not great.
No.
And that's Gen Zers will come around, but a lot of them may be very young and don't want to put aside money for their future because their future is tomorrow. They are instant gratification. So it's a goal of ours to get more of those younger clients, to get them on that road and to get them started.
Yeah, absolutely.
But a conversation is worth a lot.
Yeah. And this was a tip we gave to millennials as well, but Gen Z should absolutely take advantage of the Roth IRA. While they do not need the tax break, because a Roth IRA contributing to it right now doesn't save you on taxes today, but it saves you a ton on taxes in the future. And so, while you're young and not at the peak of your earnings, contribute to something that, it's not going to give you a tax break now, but it will in the future. And also, a lot of people don't know, but a Roth IRA, not everyone can contribute to them. Once you get to a certain income level, you are no longer eligible. And so while you're in those leaner income years, take advantage of it, because maybe by the time you get to your 30s and 40s, you'll no longer be eligible.
Definitely take advantage of it while you're in a lower tax bracket.
Yeah.
And that can just sit and grow and, have all that interest come out tax-free. It's a great investment.
Yeah. And I mean, our last tip, I wouldn't even say this is just for Gen Z. I think this is for all generations, is to educate yourself. Listen
Absolutely.
to
Yes.
podcasts, listen to YouTube videos, read articles, attend financial workshops and seminars. The educated client feels more confident in making decisions and spending their money because they know they have a plan.
And even times like this are very uncertain. Let's
Yeah.
be honest. Let's have a conversation with whatever generation we're talking about. Have a conversation with a financial planner. It's just a conversation. You can get some great information. You can have some great insight. And maybe, maybe you have to have a conversation with a few different people. But take advantage of people that do this for a living. We like to say we don't fix our own cars. We don't do our own plumbing. Even though you earn money doesn't mean you know what to do with it.
Absolutely. Yeah. And I mean, we do recognize the fact that this is important and this is people's money. They really, really care about it. They're going to care about it more than, their water heater install because this is their life savings. But that's why we like to provide education along the way. And so that you're not just blindly trusting in us, which of course there's going to have to be trust there, but you also do know what's going on as much as you want.
As much as you want.
Yeah.
As much input as you want. Some people like to be totally involved. Other people just say, just do it, and I'll meet with you once a year.
Yeah.
And that's fine too.
Yeah,
absolutely. It's all different.
Yeah, and I mean, we're living in such uncertain times right now. I think regardless of what generation we're in, everyone has their own stresses and things that are keeping them up at night financially. And so I think it's important that they have someone to go to for, what do I do? The market's dropping, or, where are interest rates at? Can I afford this house? Every generation really does have their own problems. And that's kind of what we wanted to touch on. And I think, of course, we could go on, but sharing a couple strategies and then leaving it more to an individual conversation is important.
I agree.
Well, thank you so much for coming on to another episode, Lisa.
My pleasure. Thank you for asking.
Yeah, you always share great information.
It is an honor to be able to share information. I love doing it, and I love helping people out. As you said, these funds are people's retirement. This is their life savings. We absolutely respect that and treat it as such.
Absolutely. For everyone listening, thank you for tuning in to another episode of the Future of Finance podcast. If you have questions that you would like answered pertaining to your own generation, feel free to go to our website, union-financial.com. You're free to schedule a meeting with either myself or Lisa. We can do a phone call, Zoom meeting, or in person and get your specific questions answered. I'm your host, Marissa Wood, and we look forward to seeing you next time. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.